This is Cousin and Spooman for Risk for July 13th, 2011. It's a Wednesday, and this is the first day I have been able to speak in almost about 5 days. Man, I have caught one of the worst colds I have ever had, and I'm not over it yet. Excuse me. But I just had to make a video today because today's setup was pristine. It was yelling at you to short the market, and our strategy did extremely well in handling the short this particular day. But why did we know that? Let's take a look at the premium. If you've watched us before, you know how we read the premium, and if you're not sure how to read it, go to our website, RSKsys.com, check out the section on the premium, read the rules. Now, this is not the only way that we read the premium, but it is certainly a way to read a setup on the premium, and that setup was very clear. So let's go back here to 9:01 a.m. and look very closely at what happened here. Now, the S&P premium, the large contract, which is sometimes a little less accurate with this data feed than the ESINX, showed a new high and a new low on the premium at 9:01. The ESINX premium showed a new low. Now, what was as well? The next bar on the premium on the large contract was also a new low. But given how there's some measure of inaccuracy with the SPINX, I was favoring that the ESINX was the most predictive of the two. And so there's a little judgment call in there. But based on the rules of reading the premium, it told us that the probability that the market would return to the low of 1314.25 at some point during the day was very, very probable. Program buying versus selling odds. Let me repeat that. Program selling versus buying odds was the favored direction by about 65%. And that being the case, then it's really a matter of just looking for an opportunity to short the market. Now, there's a couple of different ways that we go about doing that, so we'll describe philosophically how we do it, and then we'll show you the results of our automated trading. Now, one of the kind of the old systems that we used in determining where the most likely pivot is based on calculations off of the VIX. You'll notice that on this chart there's these what we refer to as double asterisks on the VIX, right here, and right in here. And those generally indicate to us high probability pivots. Now, normally what we see happen on the VIX is that when you get a new high on the Spoos, you're going to get a new low on the VIX. But now when that does not happen, it usually indicates that the VIX has already turned if the VIX is not hitting a new low. The Spoos are hitting a new high. All right? So the VIX hit a low right in here. It now has started to move back up. That is a form of divergence. A form of divergence which gives us strong reason to believe that the VIX is now moving up and the Spoos are going to be moving down. Another thing that this particular indicator, which is a proprietary indicator, shows us that as we begin to get these double asterisks here, it indicates that the VIX is clearly in a trend on the way up. So if the Spoos haven't really begun to move down yet, they're going to move down soon. And that's in fact exactly what occurred. So as you see here, the Spoos really were moving down ever so slowly, and if you didn't have information to help you understand what direction they were really taking, it was kind of hard for the average trader to recognize that this market was set up to go short. And as you can see here, about 2:15, which is about when we expected the low for the day to occur, in fact, we tied that low at 14.25. It's in here somewhere, I think. Maybe it's the next bar. Well, I guess it happened right in here. There we go. So at 19 after, we tied the low, and then it continued to drop lower. But we knew that for good reasons. Good reasons. Number one, what the low of the premium indicated here at 901. That was your first giveaway. There was other factors involved. There were some calculated probabilities. The program selling would be the direction of the market today, as well as the overall trend of the VIX was going up. So now it's just a matter of what are you going to use as a basis for telling you when to short the market. So sometime after 10:10, we're looking at, is there some kind of a high here that's going to allow us to short this market, right? And so anytime after that, we're now looking at a high probability short. So let's look at the automated trades. And here on our workspace where the strategies are sitting, we have our first automated short at 10:18. Now that doesn't really pan out, but then we pardon me, but then we get another short at 10:23. Now that ultimately hits our profit targets, which we have set up, but we're looking at a difference here between just taking some profits and looking for other opportunities to get into the market versus holding a trade down to the low that we were already anticipating. Now you know that's a discretion decision that you as an individual trader can make, but the strategy is just set up to take profits after a certain predetermined amount. But the big picture is to hold that trade until the new low. Now a little later on, at 11:14, we get another short that hits its initial profit target, but then gets stopped out to break even at 11:47. A little later on, another short trade here pans out well at 12:38, hits its two profit targets. Later on, once again, another couple of trades at 1:32, hits its initial profit target. It too gets stopped out at break even. Another short trade here. Portion of the strategy gets its initial profit target. Then once again, a short trade here as well as over here, and they also hit their profit targets. So what's nice about this the system here, depending upon how you want to set it up, and you can just take profits at certain predetermined amounts, subject to your own discretion, or if you understand the big picture, you're always able to hold the trade even longer until the goal is reached. Now we didn't set it up that way, but we knew that was likely to occur. So this is entirely up to the trader as to how he wants to set up our system. But this was just a great great setup today. Very easy to see, very easy to read, and with high probability. So it's just a matter of how you want to play the game. So now just a quick review of the two major components of our strategy are indicators, the two indicators being the Z-score indicator and a volume indicator that's shown on the screen. Now we're not showing Z-score on this particular workspace, but it's operating in the background. And our strategy uses a series of different tick intervals on the ES for determining the direction of the market based upon the volume indicator. In conjunction with that, we're reading the premium using our Z-score indicator, and then we're also looking at divergence based on either new highs or new lows on the ES in relationship with divergence on the volume indicator. So let me give you an example of a real clear divergence here. So let's take a look at this this time frame here, right around 10:23. Now let me blow this up a bit larger so you can see the divergence more clearly. So what we're doing here is we're reading the highs of the Spoos, and at the same time we're reading the highs of the volume. Now, notwithstanding whether there's buying going on or selling going on, divergence is still read in the same way. We read the high of the Spoos, we read the volume at the time. If the Spoos go higher, but the volume has dropped, as you can see here and here. Now this is, incidentally, this is on a 1,000 tick, this is on a 500 tick, and you can see how that volume has really dropped off. It's really dropped off. So that's what I'm referring to as divergence. Again, I'm going to save the high here. That's as high as the volume went. I'm going to hold that number. I'm going to move forward, and I'm going to read the volume as the Spoos go higher, and if my volume has dropped off, I'm considering that to be divergence. So I've got divergence all over the place in here as we're hitting these new highs, even just by 1/4 of a point. And then finally, you know, the volume on the 500 tick here is dropped to next to nothing, and boom, you know, down she goes. So, you know, if you don't have anything at all to work with, just get a good volume indicator and, you know, do a visual determination of where your volume is at, and use divergence as a basis for taking some trades. It's beautiful. It works really well. We've got an automated system that does it automatically for you, but this is a great way, you know, to pull some excellent trades. So down she goes. All right, well, that's our discussion for today. I'm looking to feel better as we go through the balance of the week remaining. Excuse me. And hopefully we'll be able to put out some more video activity during the balance of the week. But we invite you to come to our website, take a look. We haven't updated some of the things that we're doing on our website. I just simply haven't had time, but you can see a little bit about some of the things that we've done in the past. But by all means, give us a call, ask for a demo. You will be very glad you did. We regularly pass on information during our demos that will, I guarantee you, make you a better trader. If you don't decide to do business with us at all, we will make you a better trader for having gone to the trouble of contacting us and asking for a demo. I guarantee it. All right? There's no two ways about it. We can make you a better trader just by taking a demo. We'll pass on information that you would have to pay thousands of dollars for, and we'll give it to you for free. So, that's my guarantee. I know we can help you out. So contact us. This is Rod Kusin and Spooman for Risk.